Brilliant Minds in Real Estate is a podcast series that brings illuminating interviews with today's most relevant and motivating leaders throughout all corners of the real estate investment sector. I'm your host, Suraj. My special guest is Nael Mustafa. Nael is the Co-Chief Investment Officer of GFH, which is a financial services group incorporated in 1999. It has now become a leading institutional asset manager in the Gulf region. GFH is currently listed on the Bahrain and Kuwait stock exchanges and also on the Dubai financial markets. GFH holds about $12 billion worth of assets and funds under management and holds about $1.5 billion worth of assets in several yielding real estate investments across the Middle East, US, and the UK. Nael is an experienced investment banker with a proven track record in private equity, real estate, and capital market transactions. Prior to GFH, he was responsible for developing Arcapita's real estate and M&A footprint. Through his professional career, he has launched and managed over $1 billion worth of real estate-related funds in the Mena, Europe, and the US, owing to his incredible ability to identify opportunities and to raise funds. Nael, it's an absolute pleasure to have you on the show.
Thank you, Suraj. The pleasure is mine.
Now, let's start at the beginning. You've now sort of had an illustrious career in the banking space in the Middle East, and especially in Bahrain. You've had stints with BNP Paribas and Arcapita, among a few others. Talk about what it meant to be a banker in the region in the early 90s and how that's evolved over the years.
At the risk of age sensitivities, I started my career in the early 90s, and I remember vividly that when I started as an analyst, I had a computer, and the computer didn't have any internet connection, so there were no emails. We were printing, to many people, they're probably even not familiar with that type of printer that had punched holes on the side and a roller, and a lot of the papers actually comes up in two copies. Different environment altogether. Besides the lack of technology at the time, it's a completely different environment. The focus at the time was predominantly very simple capital markets in terms of transactions, and predominantly a lot of merchant banking, a lot of wholesale banking, as opposed to the investment banking or the capital markets developments that we've seen later on. First part of my career was essentially more focused on providing debt, because Bahrain at the time in the early 90s was focusing on becoming, or was, the banking sector serving Saudi and the rest of the GCC. So all the internationals had the bulk of their activities based out of Bahrain. So a lot of what we did then was more merchant banking, more funding, corporates, construction funding, and similar type transactions. It later then evolved, what is called the investment banking then evolved in Bahrain, and the players that we have now, including GFH, came into existence towards the end of the 90s, beginning of the 2000s.
That's very, very fascinating. I think just the sort of progress that we've had in technology over the last 10 years, you can barely recognize an office then. So I can't imagine what would have been like in the 90s. Now let's shift focus, Nael, to your current role as co-CIO at GFH. For those who aren't as familiar, can you talk about GFH and its current investment mandate and get into the details of your role in particular?
Sure. GFH is a financial group based out of Bahrain that is listed on the Dubai Stock Exchange, the Bahrain Stock Exchange, and very soon on the Saudi Stock Exchange. As a group, GFH Financial Group derives its business from four key areas. The first one is commercial banking, where GFH owns the majority of Khaliji Commercial, which is a Sharia-compliant commercial bank here in Bahrain that's fast-growing and, in fact, had, in relative terms, the best performance during 2020, which is the unfortunate pandemic year. Other part of the activity for the group is the educational arm, Brightus, which owns and operates schools all across the region, and soon expanding its footprint to North Africa as well. In that, Brightus not only owns and operates schools, but universities as well, and they're looking at functional training and other educational facilities all across the region. The third arm is the property development arm, GFH Properties, which develops and manages a land bank of significant magnitude that GFH owns as a result of the earlier part of its existence when it acquired and was developing lands in Morocco, Tunisia, Bahrain, and India. GFH Properties right now is considered the largest property developer in Bahrain in terms of land bank owned, as well as physical properties developed. And as I said, is increasingly now active in developing the lands that it manages or owns in North Africa and in India. The third part of our activity is the part where we sit in, which is the investment management arm, which is done under the brand name or the umbrella of the mothership, GFH Financial Group. And in there, we focus on three parts. One is asset management, where we structure products, funds that are aimed at providing yielding solutions derived out of either fixed income instruments or other income generating ideas that are structured products or similar. The other part is private equity and real estate. And in those two, we predominantly identify structured transactions that are on a global basis, the US, Europe, Middle East, and other parts of the world, with the understanding that such transactions are ultimately aimed at being syndicated with high net worth investors in the region. In that, we have different strategies. So on the PE side, increasingly over the last few years, the strategy has evolved from opportunistically looking at transactions to more tech-focused, healthcare-focused, and new economy-focused, as was evident in the transactions that were done. We acquired companies such as The Entertainer that has evolved into an online discount providing service in the GCC, in the UAE in particularly across the GCC. We acquired Marshalls, the payment platform, again based out of the UAE. We are looking at healthcare opportunities in the region, and we've been increasingly investing through a well-structured fund of funds structure or manager of managers structure in tech in the US very successfully over the past two years. On real estate, we are obviously looking at different type of exposure. So on real estate, we are looking at stabilized income yielding transactions that generally fall within two main areas. One is the logistics and industrial, which is a core part of our focus. And the second is the residential or the accommodation-based assets. And those can fall into either multifamily, student housing, or senior living. But again, market conditions permitting, our focus this year and next year is going to be more on the multifamily and student housing as opposed to senior living, which is pandemic affected for the time being. The last arm is the treasury arm, where we are very active on capital markets, fixed income, structured products, and have been extending those services from being captive prop book type into investor-related products. So that's a long-winded description of GFH and what we do.
That's very interesting. I've known you guys for a few years now, but that sort of summary just sort of hits it home. You mentioned Entertainer. I have to say I'm an avid user of Entertainer and usually end up taking a lot of discounts on a yearly basis. So that app is definitely quite useful. Nael, you spoke about real estate and you spoke about the sort of asset classes that you're focusing on. GFH recently acquired perhaps in the last 24 months, it has deployed about $1 billion across different real estate asset classes internationally. Can you talk a little bit about the importance of being consistent with deploying capital through these uncertain markets?
The strategy behind acquiring the asset managers is one that is core to GFH's plans. And those plans are to increase its total assets under management, not only regionally, but on a global basis. And one of the routes to increasing that asset management quantum is by strategically being aligned with well-positioned well-reputed, track record, present asset managers that we can either invest into or have a more strategic tie-up. So in that, we started with an acquisition in the UK with Roebuck. As you mentioned, Roebuck is a well-positioned logistics advisor, asset manager. Have done, as you mentioned, over $1 billion of transactions in logistics, with an investor list that spans Asia, Europe, as well as Africa. Roebuck plays a key role for GFH because they are well positioned and well reputed and well endowed when it comes to identifying and structuring logistics-based transactions in Europe. And that not only opens up a greater opportunity for transacting in Europe, but more importantly, it allows us to attract additional investors, additional institutional investors that will look at the likes of Roebuck and see the credibility that is needed to invest either with or alongside or through GFH in those regions. So within that, we're not finished on that regard. We are looking at a number of other strategic transactions, be it in Europe or in the region or even the US. And we're hoping that those will be announced at the right time.
That's fascinating. And apart from Roebuck, are you, for other asset managers that may be listening from Europe and perhaps in the US, are you still open to the idea of investing into other such managers?
Definitely. I mean, one of GFH's strength is that it's always open to ideas, and it's always open to opportunities, and it's always willing to consider the right investment, be it at the asset level, in partnership with an asset manager, or be it in the asset manager or the investment teams themselves. So the long answer to that is yes, GFH is definitely willing. And as I said, we are currently looking, and in fact, as you know, working with you, for example, on certain things, we are looking at transactions whereby it's simply a partnership, a typical JV of an acquisition to acquire a particular asset or assets. And we're looking at transactions in which we will invest in the asset manager themselves. So, both are on the table, and there is no exclusivity to our mandate. Meaning, if we do buy an asset manager that is in a particular sector, that does not necessarily, in and of itself, mean that we are not going to look at any other transaction except them. No, that's not on the cards at all, because, as I said, the ambitions of GFH is to grow and to grow rapidly. And the way to do that is by identifying the right partners, and there could be multiple partners in each sector.
Thanks for that, Nael. I think one thing I can second is through the advent of COVID, I've been speaking to a lot of fund managers who always talk about the amount of dry powder that they have in their books. But I do think there's a substantial difference between having all that dry powder and having the commitment and having the confidence to actually deploy. And just the mere fact that you guys have been so active over the last few months definitely means that you are here to do business. And sort of moving on from that, let's get into the specifics of one specific transaction. This was a $77 million acquisition of a high quality income producing last mile Amazon designated warehouse located in Spain, if I'm not mistaken. Logistics globally has been quite competitive, especially when you look at historic levels of pricing. How do you ensure that you are able to price the assets right, but more importantly, price it right enough to actually acquire these assets, given a lot of these opportunities are done through sales processes? So how do you hit that sweet spot? And perhaps if you could share some high-level deal metrics when it comes to logistics in particular.
Yeah, Suraj, you're asking the $1 million question here in terms of how to properly price assets that are in demand and cap rates or pricing that is on the ascent, not only this year, but particularly in a sector like logistics over the last 10 years. But how we go on about it, I'm not trying to claim any unique advantage here. It's simply the starting point and the ending point has to always be what our investors' return requirements are. In general, our investors have a particular cash on cash expectation, and any asset that we look at, once the transaction is structured and funded through a combination of equity and debt, must meet that threshold. If it doesn't, even if the asset is a good asset, even if the transaction looks interesting, we if it doesn't meet the threshold, then we are not able to do it. From there, we go into the second level, and that second level is obviously what are the comps that are there, transactions that have been recently done, the similarities of such transactions with the asset that we're looking at. And for us, we have a very meticulous supply chain and location analysis filter that determines whether that particular physical asset and that location will work from a logistics perspective or a supply chain perspective. And if that works, then that takes us into the third level. So, threshold being investor returns being met. Second is the internal metrics on location and physical specs. Then the third, which is depending on the type of asset, whether it's a long lease single tenant or a multi-tenant, what are the drivers for the income or the revenue, and how solid are these projections when it comes to predicting cash flows. And based on that, if an asset passes these three levels, then we generally proceed. Personally, though, and our corporate view is that even though probably over the last 12 to 18 months, we've seen a lot of capital chase logistics assets, obviously driven by what has happened during the pandemic. But our expectation is that there could be still further tightening cap rates in logistics, simply because e-commerce as a main driver of that is here to stay. E-commerce did not start with the pandemic and will not end with the end of the pandemic. Hopefully that happens soon. But e-commerce is here to stay. So what the pandemic has done is simply increase the rate of growth in e-commerce, but did not facilitate it or did not introduce it. It was there before and will continue after. Secondly, the demand supply, and I'm sure JLL has the data to support, not only in the US, but in US, Europe, Asia, the demand for logistics space is in many places exceeds, and in most places either matches the supply that is there. So with that, we do not seem to be looking at a scenario where supply of logistics assets is heading anywhere towards a glut, and therefore I don't see a supply pressure on cap rates. Third, if we look at Asia as a leading indicator of where cap rates are and where stabilized yields are, then there's a lot of room to go for US and European logistics before they reach Asia or Asian levels. So, again, our house view is that there is more to come, and therefore we don't approach current pricing as a red area of caution. But having said that, we are careful in terms of where do we choose the asset, with who, with what type of credit are we investing into as tenants, and location. Again, this is at the end of the day, this is real estate, so location is core to the analysis.
Very, very insightful, Nael. Thanks for that. Moving on, we spoke about current trends. If we try and expand that timeline to about 10 to 15 years, within the real estate investment realm, where do you see the next big disruption happening?
I think there are two main areas where disruption to real estate is happening, or will continue to happen. Number one, I think the disintermediation, let's call it the dealer, broker level, the agent level, and the investor level, whereby we're starting to see at a shy pace, but I expect personally that will continue to increase. Online platforms that allow you to identify assets, transact on assets without the need of the typical intermediaries that are there. That's one side. We're starting to see it, again, as I said, in a very shy manner on the individual level, apartments being offered or individual units being offered. But I think that momentum will continue to increase and will disrupt the current manner in which we as investors of real estate will identify where and how assets are offered. The second area where I think there will be a lot of disruption is the liquidity front. Or the transactability front. So right now, when we invest in an asset or a transaction, we have a holding period, and then subsequently, 99% of the time, for us and for others, the exit is a sale to another private pot of money. That, I believe, is going to change dramatically by the increased access to tradability, to listing of private assets on either online or actual physical exchanges. And I think, in 5 to 10 years' time, we will probably see the buy side and the sell side of assets become more digitized compared to what we see right now. So, what that means for us as investors is that, are we ready to have open-ended platforms? Are we ready to have themed pools of assets? Are we ready to have the ability to manage assets for horizons well beyond the typical 3 to 5 years? So what does that mean for you in terms of strategy? What does that mean for you in terms of human resources? What does that mean for you in terms of even your selection of transactions? That will all play a role. And then again, on the buy side, right now, good relationships with agents will get you access. In the future, a lot of people will have access in perhaps the same amount of time, will have access to the same amount of data, and speed of execution and ability to execute will become more competitive than what it is already at this stage.
Nael, you touched upon a lot of interesting topics there. I think the future of real estate transactions as well as intermediaries is definitely going to change. Take blockchain, for example. My understanding is a lot of advantages there with tokenization, whereby you're increasing liquidity, reducing overall barriers through crowdfunding or institutional crowdfunding. You could use smart contracts by digitizing these contracts, ultimately leading to reduced fees, secured and faster payments, reductions of fraud. Property management as well, I think, is a big advantage with regards to how blockchain can help. I would love to sort of sidetrack a little bit and ask you a little bit about things that are trending, which is Bitcoin and Ethereum. What's your take on both these alternate currencies or assets?
Well, it's as we started our conversation, you're talking to a guy who started his career in the 1990s. So I've gone through 3 rounds of euphoria that we've seen. So I've seen what happened in the dot-com bubble in the 1998, 1999, and leading into the early 2000s or 2000 when the bubble burst. I've seen what happened obviously before the financial crisis in 2008. And a lot of these, unfortunate lessons don't seem to have been learned. So we see the exact same thing right now happening with Bitcoin and perhaps some aspects of the listed market. But the rule of thumb is when things reach, the taxi drivers, when you go home and you sit with your parents and they start mentioning things like Bitcoin, and then that the level. Exactly, the trouble is now. Is it trouble tomorrow? Is it trouble day after tomorrow? God only knows. I don't think anybody can sense it. But the crucial question for me is, as long as there are central banks who do not recognize Bitcoin as a currency, as long as there are various anecdotal stories, but they remain as such. They remain anecdotal and they remain funny, interesting. Stories about that as a currency, but that can only change when central banks decide to adopt Bitcoin or any of the others as a regulated and as a formal form of capture of value. I mean, the other thing on Bitcoin as well is that is there enough of that in supply? The amount that is there, what is the amount of power that? I was reading an interesting thing yesterday that the amount of power that is needed to mine for Bitcoin exceeds the power supply of countries. So, I don't think a lot of traders, the general public, are interested in any of that. They only see it at 40 going to 50 and 50 now possibly going to 60. And, everyone who hasn't jumped on the bandwagon and was doubtful is now thinking to catch the hot potato. But who drops it is the question. And when will it drop? That is the question.
I fully agree. I think that analogy of every man, his dog, and the dog's auntie, when they start trading Bitcoins, you know that you probably want to be a little cautious. Coming back to real estate, Niall, you're clearly on the board of various investment committees, and you have been over the last 15, 20 years. Oftentimes you see a lot of these opportunities coming from the top down. You have the deal team getting access to deals from members of the investment committees or various senior members. Talk to us about some of these typical conflicts. Is there conflicts, and how do you sort of manage those, wherein opportunities are being seen for what they are rather than being seen because that is through an internal connect?
I can perhaps at this stage only talk about GFH, and I can tell you we don't have that here. It's pretty much bottom up in terms of the opportunities. So the way we have, as I mentioned earlier, we have teams looking at various parts of the investment arena, and in real estate in particular, we have teams within teams that look at various sectors. They engage with various sources of deals, and then based on suitability of individual deals, they get referred up. Like any institution, like any business, does the odd transaction come from top down? Yes, but again, luckily so far we don't have transactions that are passed down with here's a transaction that has to be done, because at the end of the day, the model and the business is driven mainly by what can be sold to investors. So if the transaction is sellable to investors, be it private equity or real estate or any other, if it's sellable, it has the right profile, then it really doesn't matter whether it comes bottom up or top down. But if a transaction it doesn't matter where it comes from, then it won't get done. So for us, the key metric here is if this transaction is put in front of an investor, would they be willing to part with their money and invest in it? That for us is the ultimate conflict resolution mechanism. Because we can argue about sectors, we can argue about merits of certain countries or certain regions, we can argue about return risk profiles of this deal or that deal, but if that return risk profile is sellable, once the relevant team has done the supporting work to it, then the decision is taken.
That gives me a lot of perspective, Niall. Coming on to more fun things, I hear that you are an avid reader. Can you talk a little bit about some of the books that you're currently reading, or perhaps touch upon some of your favorites?
Because we spend a lot of time reading business stuff, I try to keep a lot of the non-work related or non-business related readings more on the lighter side. So quite an avid fan of a writer called Douglas Kennedy, who's a novel writer, mixes personal tragedy, growth, experimentation with a bit of social twists. So a lot of times, if I were to pick a novel, he'd be my first go-to author. Another type of books that airport bookshop books. So normally whatever is on the top 2, 3 of mystery or suspense novels that I can get my hands on and enjoy the flights or the lounges doing that. And then a secret not to be shared, but except on the podcast, is that I'm an avid comic reader. So
very fascinating.
with the recent Marvel TV shows of WandaVision, I've been going back trying to read all the comics about Wanda and her background and her history and how she has evolved into where she is, and what's next. So that's as I said, that's between us and whoever listens to the podcast.
Well, hopefully not too many do, so your secret's safe with just us. I really appreciate your time, Niall. Thank you so much again. It's an absolute pleasure to have you on the show.
Thank you so much, sir, for the opportunity, and enjoy talking to you.